Most Canadians think of their TFSA as a simple long-term savings account, a place to park investments and watch them grow tax-free. But here's the thing, after age 65, your TFSA becomes so much more than just a growth tool. Used correctly, it can become one of your most powerful tax planning assets in retirement, helping you reduce income taxes, avoid OAS clawbacks, and create flexible income when you need it most. But if you just leave it sitting there, or worse, treat it like a backup account, you could be missing some of its biggest benefits. Hi, I'm Stefano Francesca, Certified Financial Planner Professional at Next Step Wealth Management with IPC Securities Corporation. In this video, we're going to cover why the role of your TFSA changes after age 65, how to use it strategically in retirement, and what most Canadians get wrong when it comes to withdrawals and contributions. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. Let's get into it. Number one, why your TFSA becomes even more valuable after age 65. The TFSA is already a powerful tool. It lets your investments grow tax-free, and unlike RSPs or RIFs, withdrawals don't count as taxable income. But after age 65, the TFSA plays a whole new role in your retirement income strategy. Here's why. At this stage of life, your income level starts to impact more than just your tax bracket. It also determines how much old age security you keep, whether you qualify for the guaranteed income supplement, and even how much you're taxed on your RIF withdrawals. So the more income you can draw from non-taxable sources, like a TFSA, the better. Let me give you an example. Let's say you need an extra $10,000 this year for a home renovation. If you take that from your RIF, that $10,000 gets added to your taxable income. Depending on your bracket, you might lose 30 to 50 cents on the dollar to taxes and OAS clawbacks. But if that same $10,000 comes from your TFSA, no taxes, no OAS clawback, no problem. That's why your TFSA becomes more than just a growth account after 65. It becomes a strategic tool for managing income, preserving benefits, and protecting your lifestyle. Number two, strategic TFSA contributions after retirement. A lot of Canadians assume that they can't or shouldn't contribute to a TFSA once they stop working. But that's not true. There's no age limit for contributing to your TFSA, as long as you're 18 or older and a Canadian resident. And unlike the RSP, it doesn't require earned income. So even if you're fully retired, you can still top up your TFSA every year. For 2025, the contribution limit is $7,000. And if you've never contributed before, or you withdrew funds in previous years, your available room could be much higher. As of 2025, the total lifetime limit since the TFSA's creation in 2009 is $102,000. Now here's where it gets strategic. Let's say you're drawing income from your RIF and receiving CPP and OAS. If your spending needs don't exceed what those provide, you can take your RIF withdrawals and reinvest them into your TFSA. You're required to withdraw from your RIF anyways, but you don't have to spend it. By moving those excess funds into your TFSA, you're keeping that money growing tax-free, creating a future source of tax-free income, building a buffer to draw on in years when your other income might spike. It's just a smart way to flatten your tax bill and maintain flexibility in your retirement. Number three, tapping the TFSA for tax-free retirement income. Once you've built up your TFSA, whether from pre-retirement savings or RIF reinvestments, you now have an incredibly flexible tool for generating income. Why? Because unlike RIFs, CPP, or OAS, TFSA withdrawals don't count as taxable income. That means they won't increase your marginal tax rate, trigger OAS clawbacks, or impact income-tested benefits. Let's walk through a quick scenario. Mary is 74 years old. She receives about $10,000 a year from CPP and $8,800 from OAS. She also takes withdrawals from a RIF, about $37,200 annually. That puts her taxable income at $56,000. Just below the next tax bracket in Alberta in 2025. Now let's say Mary wants to help her granddaughter with university tuition. Rather than taking a larger RIF income withdrawal, which would increase her taxable income, she draws $10,000 from her TFSA instead. The result? Her taxable income stays flat, she doesn't pay an extra 6 to 8% tax in the next tax bracket, and her TFSA continues to make gains on the remaining balance, tax-free. This flexibility makes the TFSA a powerful source of just-in-time income, whether it's home repairs, health expenses, travel, or family support. Using your TFSA helps control when and how much tax you pay. And over a 20 to 30-year retirement, that tax control can save you thousands. 4. TFSA planning for the surviving spouse. One of the most overlooked benefits of the TFSA is how it behaves after one spouse passes away. And this is especially important for Canadian couples in retirement. When one spouse dies, the surviving spouse often faces a so-called widow's penalty. higher taxes on the same income, loss of one OAS benefit, reduced CPP benefits, and potentially more RIF income concentrated on a single tax return. But here's where the TFSA shines. TFSA assets can transfer tax-free to the surviving spouse using a special election called a successor holder designation. That means the surviving spouse can keep the account intact, no need to liquidate or reset the contribution room. It continues to grow tax-free, and withdrawals remain tax-free as well. Let's say Mark and Anita are both 75. Anita passes away first, leaving $150,000 in her TFSA. Because Mark is named as the successor holder, he simply takes over the account. It becomes his TFSA with no tax hit, no probate, and no loss of contribution room. This is why planning not just for retirement income today, but for the survivor situation tomorrow is critical. And the TFSA provides a uniquely powerful lever for that. 5. Using the TFSA for estate planning. Most Canadians know the TFSA is tax-free while you're alive, but many don't realize it's also one of the most effective tools for passing down wealth to your family. Why? Because unlike RSPs or RIFs, which are fully taxable at death unless rolled over to a spouse, TFSA assets pass to your beneficiaries tax-free. Let's break that down. If you name your spouse as a successor holder, they can take over the account, as we covered earlier, and it remains completely tax sheltered. But if you name adult children or grandchildren as beneficiaries, here's what happens. They receive the entire TFSA amount, tax-free, outside of your estate. The only thing that they're responsible for is the tax on the growth of the account after the date of death. It avoids probate in most provinces, especially if you've named a direct beneficiary on the account. And unlike RIFs, there's no terminal tax bill or tax slip added to your final return. That means if you built up $100,000 or $200,000 in TFSA assets over your lifetime, your children or grandchildren will receive the full amount, not 50 or 60 cents on the dollar after tax. And because TFSA withdrawals don't show up as income, they also don't impact your final year's OAS, GIS, or other means-tested benefits. So if legacy is important to you, or you simply want to leave your family something without triggering a tax mess, your TFSA should be front and center in your estate plan. If you're wondering, am I using my TFSA the right way in retirement? Should I be withdrawing, contributing, or doing both? How do I reduce taxes and keep more OAS? Then let's talk. Click the link in the description to book your consultation. We help our clients walk through their income sources, their withdrawal strategy, and how to make the most of their TFSA going forward. Let's take the next step.